Welcome back to Rich Dad Stockcast. I'm your host, Denney, and today we're going to simplify what most people overcomplicate when it comes to investing. You don't need a crystal ball to pick the next big stock. You need a framework, a proven system for making smart decisions no matter what the market's doing. And that's exactly what we're going to cover today. The 4 pillars of investing that every smart investor uses, whether the market is up, whether it's down, or whether it's sideways. And we've got Rich Dad expert Andy Tanner here to break it all down for us. And trust me, you're going to want to take notes. But first, go to stockcastbonus.com. That might be your first note right there. Grab your free investing tools. If you're tired of guesswork or if you're tired of hype, that is where clarity starts. That's stockcastbonus.com. All right, let's get into it, Andy. Andy, welcome back to the show.
Love talking about the 4 pillars, so this will be great.
I love the 4 pillars. I can't wait to break this down. But before we get into that, stockcastbonus.com, it goes exactly with what we're talking about today. But there's some more stuff in there. What happens when our listeners go to stockcastbonus.com?
Well, free stuff, first of all. We always offer free stuff so people can get to know us better. We have education of all different prices and sizes, from free all the way up to however master's PhD level, quote unquote, you want to go. But it's always best to start off by getting to know your teachers, and Stockcast Bonus is a great place to do that. We are big into systems in fact, we're going to talk about a system today. And so, when a person enters a system, it's almost like why franchises are so successful is they're highly duplicatable in most markets. And so that's what we do. And so at Stockcast, you begin your first lessons of generalized principles that are true in all cases that you can start to apply. You'll learn about cash flow. You'll learn how different cash flow patterns look in different financial statements. We have labels and names for these financial statements. And it's really a fascinating journey. It's a lot of fun. You'll absolutely have your eyes open to new things. And then also it's for action takers. People that get tired of consuming content, want to do something with it. We have habits and practices and regimens and, just great information there. So go, if you haven't signed up for free yet, go sign up for that free stuff.
There you go, stockcastbonus.com. All right, so Andy, most people, they jump into investing, think it's all about finding the next hot stock, right? The next hot stock, as you hear. But
yeah,
let's be real. Why do so many people lose money even when they think they've done everything right? Like, what are they missing?
Well, they live in a culture of advice mostly. They'll get a tip from someone or whatever, and the chances of picking the next, penny stock that goes to $1 are really small, and the chances of picking the next, double-digit stock going to a triple-digit stock, it's very, very small. We like cash flow better. When you look at real estate, it isn't that you, found the real estate just, pennies on the dollar and got lucky and it exploded. I mean, it's just real estate. A housing's A, B is B, C is C, right? Section 8 is Section 8. It is what it is. And you just participate and begin getting your cash flow machine going. That's how I like to go about my stocks, is the same way, is to, get your dividends going, get your cash flow going, get your options going. And, you can start to use the leverage that options brings instead of the leverage of debt. You have debt-free leverage. So it's the same approach very much as real estate people take, but it's a cash flow approach rather than a buy low, sell high approach. Why do I want to get rid of my asset? I don't. So in real estate, you have house flippers, buy low, sell high, speculators, and then you have people that rent. And I prefer the latter of the two. Well, in stocks, you have people that buy low and sell high, like the flippers, and then you have people that cash flow, and I prefer the cash flow in both asset classes.
Very nice. Now, what's the difference between a strategy and a system? And I think that helps guide us into this conversation of the pillars here.
I think strategies can be part of systems. I mean, a system is a recipe you follow, a standard operating procedure. Systems have to do with checklists and checking off boxes and doing things in a certain order. And that's really what an investing system might encompass strategies within it as parts of that system. And I think that's a big difference. And when I used to give a lot of speeches, I would speak about those four pillars, even back when you and I first met 20 some odd years ago. I would speak about the four pillars a lot. So when Robert was very kind, asked me to author a book in the Rich Dad series, Advisor series, I called it, Stock Market Cash Flow, the Four Pillars. And I introduced these four things. And, there's just four things that can apply. It's not stocks either. It's everything. It's business, real estate, commodities, whatever asset class you're in. The four pillars are everywhere. And everything I've ever done as an investor, everything fits very nicely within those four. And so if you can learn those four, you have a great foundation for whatever asset class you want to dive into. It just so happens to work with stocks just like it works with real estate. Same.
Now, after the break, I want to dig into each one of these four pillars.
Okay.
But before we do that, can you give us a high-level overview of the four pillars, what we're about to talk about?
Yeah, there are four areas of study. There are four different places to look. I can tell you what they are. The first one is how to fundamentally analyze things. That's how you analyze a business. The second is price movement. It's technically analyzing charts and price movement. And that's just information gathering. Once you have those two types of information, now we need to take action on it. And so pillar number 3 is your cash flow pillar. That's how you position yourself to receive cash. As you see how cash flows through financial statements, you're going to position yourself in front of that cash flow to let it come to you. So it's positioning. Then finally, the most important pillar is risk management. In football, you have this thing called sudden change, and there's an unexpected interception or a penalty we weren't really counting on. And all of a sudden, it's fourth down, or the punter gets the ball snapped over his head. Bad things happen, and so your ability to deal with sudden change in the market. And I say sudden change rather than being wrong. Everyone says, "Well, I was wrong about this stock. I was right about this stock." No, you were right about the stock. Things just changed, right? And so, it wasn't a mistake to marry her. Things just changed after it happened, right? It's just how it works. And so it's not a mistake. It's just a new change. And that's the way investing is. The market might change, the business might change, and so we'll change with it. So that's the four pillars.
All right. I can't wait to dig into each one of these. I think they're so important. But before we dig into each and every one of them, what happens if someone skips just one of those pillars?
Well, it'd be like anything, any part of a foundation. If you had four pillars on a house and one of them is gone, you might stand on the other three it's pretty rickety though, and you take two out and you're over. So it'd be like a four-legged stool missing one leg. Might hang on but it's better to have four. So yeah, and they're all. I mean, none of them are optional. If there were five pillars, I'd say here's the fifth one. If there were three, there'd be three, but. Turns out that as the world is, there's four. And so we want to have all four.
Very good. All right. So let's do this. Let's go to break because I want to give us enough time to really dig into all these four pillars. So, listeners, as too many people, they treat investing like gambling, but the rich, we treat it like a business, and every good business has that solid foundation that Andy just talked about. So when we come back, Andy's going to break down the four pillars of investing, what they are, how they work, how you can start using them. And if you want tools to help you to apply what you learned today, visit stockcastbonus.com. We've got free resources to help you build smarter investing habits right now. That's stockcastbonus.com. Stick around. We'll be right back.
So far, it's been great. I needed a source where I could really enrich my education through stocks. I didn't really have an avenue for it, and it's helped me a lot. The simplicity has really gotten me on the track to where I enjoy the learning as well as it's really solidifying in my mind. And they're not just trying to sell you something, they really care about the people that are in the course, and they really do care about you and your personal goals, and what you want to do is to help you and your family and whatever your goals are in life through that. So it's really been great.
Welcome back to Rich Dad Stockcast. I'm here with Andy Tanner, and now it's time to break down the four pillars of investing. This is the system, the wealth you use to win consistently. I love that word, consistently, regardless of what the market is doing. So, Andy, let's start with the basics. Fundamental analysis. What is it? Why does it matter so much to long-term investors?
Well, my favorite metaphor to help people discover fundamental analysis is a checkup at the doctor. So you go in the doctor, and there's just certain things that are fundamental to health. They're going to say, Andy, step on the scale. Let's get your BMI. I'm like, really? Okay. They're going to, pull my A1C and see what my sugar is. They're going to look at cholesterol. They're going to look at my heart rate. They're going to take my blood pressure. And this is fundamental data. Well, what does fundamental mean? It means the important stuff, right? The basic, foundational, important stuff. And what's really nice is if you went to a doctor's office all day and watched these people go in and out for all their checkups and physicals, at the end of the day, you might say, all right, doc, these guys are all going to run a 5K. Who's going to win it? And he'd say, well, I don't know if I could tell you who's going to win it, but I can tell you who's not going to finish. and they'll eliminate, it helps you eliminate a lot, like right out of the gate, right? There's just boxes they don't check. And if you're going to start a track team and you sat in that doctor's office every day without even seeing the patient, just looking at their numbers, you'd know who you weren't going to go after right there. So the process of elimination begins where in the search for a great investment, we get to eliminate a lot of stuff based on criteria. Now, when you look at who might win it, Warren Buffett has said this about diversification. He says, why would you put all money equally? Why would you put, like, let's say your top 30? Why would you put as much money in your 30th one in list of attractiveness as you would in number one? He says, that strikes me and Charlie as madness, is what he says. Madness. Just psycho crazy to do that. So the more criteria we get in analyzing a business, there's just certain numbers. And here's the beautiful part. The numbers are the same no matter where in your world you go. That's why Buffett is investing in Tokyo recently in the past couple of years as much as the U.S., because the numbers are the numbers. I mean, if I go to Japan and I say, let me look at your business, I'll be able to see how much income they have, how much expenses they pay, what's left over, what is their operational cash flow. Operational earnings is the most important number Buffett looks at, he says. I can look at their assets, their liabilities, the equity they have. I can look at their growth. Every fundamental number, any business, entity, school, government, household, nonprofit, church, all of them have a financial statement. And so there's just certain things that should be in line health-wise with that financial statement, just like a person going to the doctor. So fundamental analysis is exactly what it sounds like. Fundamentals means basic, important stuff. If you're a basketball player, you have to dribble, pass, and shoot. Those are the fundamentals. If you can't do those three things, you're not going to be very good. So that's fundamentals, is the basic stuff. Analyze means look at it carefully. Look at it carefully. So learning fundamental analysis means I'm going to learn what those basic criteria numbers are, how a business should perform. I'm going to look at each one carefully, and that's it. The best place to learn how to do that at a basic level is to play the cash flow game. That is the best place on planet Earth for a beginner to learn fundamental analysis, because that's the whole game. It's all played on the financial statement. It's all about manipulating your financial statement and knowing what a good one and a healthy one looks like and how different types of investments will affect that financial statement. It's the best way to learn it by far.
That's amazing. I never thought about that, but that is spot on. That playing the cash flow game is like learning fundamental analysis. That makes total sense. Now, going to pillar 2, technical analysis. Let's talk about charts. What is technical analysis? How can it help investors?
Yeah, so there's this battle that goes on between fundamental analysts and technical analysts, and they say, well, you should use fundamental data to pick a stock. And the guy says, no, you should use technicals because it's all about price levels. And technically, this is what it's worth, what it can be sold for. And I just, as I watch these guys fight, I'd say, why wouldn't I use them both? Particularly if I'm going to add options. You invest in stocks and you trade options. Why can't you invest in options? Because they expire. There's no longevity to them. So it's like rent, right? It's about the price of the rent and where it goes up and down. And so we want to be able to understand price levels when they're a little bit too high. And we can do that both fundamentally and technically. We can do it both ways. There are behaviors A stock chart tells the story of fear and greed. It just tells a story, and you can see where people are fearful and you can see where they are greedy, but plain as day. And learning those charting skills, we start seeing points of support and resistance, and it just creates a more opportune time when to enter. Particularly when I sell options, I care a lot about technical analysis and standard deviations. I care about the price chart. If I'm going to sell options, I care about those things. So understanding the company fundamentally is fundamental analysis. Understanding the whims of the market and the fear and greed of the market is technical analysis. We like to have both of those. We like to understand the company. We like to understand the mentality of the mob, the market, and their psychology. And those two together are worth more than just doing one or the other. It's best to do them both.
Okay, good. I understand the give and take with the battle between a fundamental analysis and a technical
they fight
trader.
all the time, and I'm like, you should know them both.
I feel like it's on my shoulders as well. I'm fighting between those two. It's like the two devils or whatever. Pillar 3, cash flow. We all love cash flow, right? This is one of Rich Dad's staples. Why is cash flow so critical to investing success?
So cash flow is about positioning. You're putting yourself in a position for cash flow. And it really has to do with how you invest. So, for example, some people might look at a stock and look upward and say, well, how high the stock's going to go. A real investor would say, how can I leverage this for less money? Through, like in real estate, it isn't how much the real estate costs, it's how much I have to spend to take control of it through a lever, right? If you're a sponsor of a syndication, you've got debt and you've got equity, and you're going to raise the debt and you're going to raise the equity together and pay nothing for the property. And so it's really about now you're in a position where you have no money in the deal. So if you can get cash flow with no money in the deal, you're in an infinite return position. That's really what positioning is. So a person could buy a stock. Well, they could buy a stock and get a dividend. Well, they could buy a stock, get a dividend, write a call. Oh, they could not buy the stock, buy the option to buy the stock long-term in a leaps and then sell the call. And it just goes on and on and on. And so you have so many positions you can take, from buying stock, selling stock, buying calls, selling calls, buying puts, selling puts. Those 6 transactions, there's an innumerable combination of things you can do with that. And so it's how you're going to position yourself in your blueprint to achieve your goals. A wealth plan is a battle plan. It's a fight. A wealth plan is a construction plan. It's a construct. A wealth plan is an escape plan to get out of the rat race. You're going to dig a tunnel out of there. A wealth plan is a personal development plan to deal with your own weaknesses of greed, fear, inconsistency, laziness, overaggression, whatever your weaknesses are. So a wealth plan is very much about that cash flow pillar. How am I going to position myself in Bitcoin? How am I going to position myself in gold? How am I going to position myself in real estate business or stocks, paper assets? So it's your positioning that you take is pillar number 3. How are you going to take the knowledge of fundamentals and your knowledge of technicals, that gathering of information, and position yourself for maximum profits with minimal risk? That's
right.
Cash flow pillar.
That's cash flow pillar. That's the third one. And then the fourth pillar, risk management. So
most important one. Yeah, for sure.
All right. So why this it might be the most ignored one, but the most important one. So tell us more about pillar number 4.
So as Robert would teach, risk is about control. The more control I have, the less risk I have. The less control I have, the more risk I have, which is why options are so important, because they bring in tremendous amounts of control and therefore risk management. So insurance is a way to control loss, right? I mean, I can't control the fire necessarily, but I can control the loss with insurance. I can't control the car accident all the time, but I can control the damage costs by insurance. And so, I put my seatbelt on for a reason. I drive the speed limit for a reason. Warren Buffett has something called a moat, which is defense against assault, like a castle, a wide, deep moat. These are all risk management ideas to give me more control over the asset, and to make sure that I'm in a position that can be safe or adjusted to be safe. And so yeah, risk management is the most important pillar. It has to do with position sizing, hedging, adjusting, rolling out, rolling up, rolling down, exit strategies. The people on the Titanic didn't die because the ship sank. Not at all. The people on the Titanic died because of insufficient lifeboats.
Mm. That's a good
Had
mic
nothing
drop.
to do with the ship. Had nothing to do with the ship sinking. It had to do with no risk management, no fourth pillar, no lifeboats.
Wow, that is such a gem right there. My mind is blown just thinking about that. It's spot on. They didn't have risk management to its full capacity.
Yeah,
So as we think about risk management,
I mean, well, think about this. Would you, if you go on a cruise and you have the muster station, you do the drill before you leave, right? You have to know where your thing is, and everyone puts on the vest. You kind of go through that safety thing before you take off. Well, if you were on a cruise ship and they said, "Hey, this one's unsinkable," like the Bitcoin people, this is unsinkable. Can't sink this one. Right there, run for your freaking life. Now, if someone says, "No, let me show you, put your life jacket on," okay, I'll listen. So yeah, the person who says there's no risk here is not managing risk. they're not a risk manager.
all right. So don't invest like the Titanic. So what are some of the tools or mindsets that smart investors use to manage downside?
Well, there's a book called The Unfair Advantage by Robert Kiyosaki. And in that book, he has each of his advisors weigh in on a few things. And the thing he asked me, says, what's the difference between an amateur and a pro? And I said, well, it's how they get cash flow and how they manage risk. Most people try to get their cash through capital gain. More savvy investors do it through cash flow. Most amateur investors try to answer risk through diversification, which is insane, really dumb, really stupid. As Warren Buffett says, it's madness, complete madness. He says it's a confession that they don't know what they're doing. Like the moment you diversify, you're confessing ignorance, financial ignorance, the moment you do it. Rather, a hedge, an insurance policy is a better way to insure something. I mean, if you had 100 houses, would you rather just hope none of them burn down, or would you have insurance on each one? Well, if you diversify, you just hope, some will burn down, some won't, right? No, you would want to have, like, especially in California, you do want to have fire insurance on every house you ever had. So you want to spend money to buy insurance on stocks, on real estate, and in stocks, it's called a put option. And they're not expensive.
So thinking about these four pillars: the fundamental analysis, technical analysis, cash flow, risk management. How do we apply this in our investing? So we know the four pillars. Walk me through, what does it look like when, okay, it's time to click and get paid? How do I run through that in my mind?
You do it in order, 1 through 4. The last thing we do is risk management. So the first two are about criteria. So that's a real good question. How does it apply? Well, once I know, like we'll go back to that doctor metaphor, they know what an A1C should look like. They know what cholesterol numbers should look like. They know what a BMI should look like. So there's certain criteria that they lay out and say, look, this is what a healthy person looks like. And if you had a database of patients, you could search, and you'd say, search, go fetch, and it'd bring back a list of names of all the people that were in optimal health, and you'd start there. Well, that's the same way you would use fundamental analysis, as we say, this is the things we like. These are the numbers that we require to even look at you as a candidate. Hit your search, boom, you've got a list of stocks right there. Then you go to technicals and say, well, let's do criteria technically. What type of market do we want to see? What type of sentiment do we want to see from the market before we buy something? Run that again. So now we've narrowed it down to a handful of investments that we feel are the best of the best. Then what we do is we say, how do we want to position ourselves? We have a calculator we give our students to show them, how well they have to do to hit their goals, how much risk they have to manage to hit their goals. And then you're going to say, all right, my education level needs to be equal to my goals. That's a real good way to think of it. You know, I tell my kids, you know, they want to play basketball. That's fine. Great. You want to play. But the truth of it is your talent level, your practice, your skill, and your IQ in the game needs to be equal to your goals. You know, if you want to be a varsity starter, your talent level, your toughness, you got to be that guy. Well, the same is true here. If you want to be a successful investor, well, be a successful investor. You know, be it. Be, do, have. So that's where the 4 pillars come in. Is that third pillar? You position yourself accordingly. If an asset lacks the horsepower to get me to where I want to go, it's off the list. For example, if I have a goal to go to the city park and that's just bliss for me, give me a bicycle and I'll hop on that bike and drive down to the city park, and that's all I need. It's got plenty of horsepower to get me that block and a half to the city park. But if I want to go to Hawaii, bicycle just got taken off the table, and so did a car. And maybe a boat, but a boat would take a while. And I'm probably looking at what kind of plane I want to take and what kind of flight I want to enjoy. And so the horsepower is really important in pillar 3. Then finally, risk management is, you know, position size and sudden change. And that's how those apply, as they apply in order. Criteria, positioning, risk management.
I love that. My mind is such a structured recipe by the boat. I love the 4 pillars. Now, if someone, and this is my final question, if someone's listening to this and they realize they've only been focusing on 1 or 2 of these pillars, what's one action they can take this week to start building a more complete strategy?
Well, I have this thing called the education continuum, and I think the biggest mistake people make with the 4 pillars is when they think they know them, because I certainly don't know them yet. I'm on a continuum. Am I happy with my level of, fundamental analysis ability? No, I want to be better. Am I happy with my abilities as a technical analyst? No, I want to be better. All 4 pillars. I want to be a better risk manager. So it's, if someone says, "Oh yeah, I know all that," they can't get better. Oh, I already know all this. They can't get better. So it's on really a continuum. So that's why we start people at Stockcast Bonus. That's a great starting place. It's a place to get their feet settled underneath them and learn the very, 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 very first lessons, even pre-4 pillars, to learn very basic lessons to prepare them for their education journey in order, like you say, you know, systematically.
Yeah, it's all about the system. Well, Andy,
Yeah.
thank you so much. Listeners, if you've taken anything from this episode, let it be this. The stock picks don't matter if the foundation is broken. These 4 pillars are what the rich rely on to win consistently. And again, big thank you to Andy for breaking this all down for us so clearly. And listeners, if you want to go deeper, make sure you visit stockcastbonus.com. Download your free tools. Start building your own investing system today with a foundation that actually lasts. And if you got value from this episode, make sure you like, you subscribe, share it with someone who's ready to get serious about investing. Listener, you're not here by accident. You're building something that most people won't. Stay smart, stay invested, and we'll see you next time.
Thanks, Del.
This podcast is a presentation of Rich Dad Media Network.